Welcome back to the Deep Dive. We're the show that tries to cut through the noise on the big topics in finance, in tech, and, well, especially where those two collide. Today we're tackling something that sounds maybe a bit dry, but honestly is probably one of the most profitable corners of the whole digital economy. We're talking stablecoins. I mean, just look at the sheer scale. You got Tether, Circle, even newer players like PayPal with PYUSD. These aren't just side projects anymore, are they?
No, not at all. They're huge, multi-billion-dollar operations. We're talking what? A combined market cap north of $150 billion now. They're absolutely central to how liquidity moves around the globe digitally.
Exactly. But here's the thing that always gets me, the kind of paradox we need to unpack today. They don't print money like a central bank. They're not making wild bets like some crypto assets. They just issue these digital IOUs, right? Pegged one-to-one, usually to the US dollar. So our mission, our deep dive today, is to figure out how they do that. What's the actual mechanism? How do they get these enormous valuations, often beating traditional banks, just by promising stability?
That paradox is really the perfect starting point. Because to get why they're so successful, you have to stop thinking coin and start thinking, well, function. Stablecoins are the bridge. They're the essential connection point, the on-ramp and the off-ramp, linking the, let's face it, often chaotic crypto world with the established traditional financial system. And if you want the secret to the billions they're making, don't just see them as digital cash. Think of them more like super efficient crypto-native money market funds. That's closer to the mark.
Money market funds.
Yeah. They take the dollars users give them, they invest those dollars in safe, boring, yield-generating stuff, and they keep the interest. All while providing this 2047 liquidity layer that, honestly, the whole digital asset world relies on now. It's that double act liquidity provider and asset manager. That's really the core of it.
All right, let's dig into that shadow bank idea then, because that sounds like where the real money-making happens. The basic promise is trust, isn't it? You give them $1, you get a token worth $1 back. USDT, USDC, same idea.
One-to-one backing. That's the fundamental promise. Convertibility. You should always be able to get your dollar back.
But how they hold those reserves, that's the clever part, isn't it? They're not just sitting on piles of physical cash earning nothing.
Absolutely not. That wouldn't be much of a business. The reserves are strategically invested. We're talking cash equivalents, reverse repo agreements sometimes. But the big one, especially right now, is short-term U.S. Treasury bills. T-bills.
Right, T-bills.
Yeah.
Basically, lending money short-term to the U.S. government. About as safe an asset as you can find anywhere on the planet.
Precisely. And the business model, the genius of it, is all about the yield they earn on those reserves. It's a float, like in insurance or payment processing. Think about it simply. You give Circle, say, $100 for 100 USDC tokens. You get this digital dollar you can send anywhere instantly. Circle takes your $100 and invests it, probably in those T-bills we mentioned. And they pocket the interest earned on your $100 while you're using their token.
Okay, that's the aha moment right there. And when you scale that up, let's use the example you mentioned, the one from the sources. Say Circle's holding $30 billion in reserves. That's a huge float that basically stays stable because people are always using USDC.
Right, it churns, but the overall level tends to stay high.
And if they're investing that $30 billion mainly in treasuries, and let's say treasuries are yielding, what, roughly 5% right now, thanks to the Fed?
Could be around that, yeah, depending on the exact mix and duration.
So $30 billion times 5%, that's $1.5 billion. In potential annual profit, just from holding the reserves safely.
Exactly. Relatively low risk profit, too, because the underlying assets are so safe.
$1.5 billion.
Yeah.
Just for being a settlement layer and managing assets passively, it's kind of staggering, isn't it?
Yeah.
And that's how they operate, like these digital shadow banks.
That's the term often used, yeah. Because they perform bank-like functions, taking deposits, facilitating payments, but crucially, without the same regulatory burden.
Right. Tell me more about that regulatory difference. What are they not doing that a normal bank has to?
Oh, it's a long list. Think about a traditional bank. They have huge overheads, billions in FDIC insurance premiums in the U.S., strict capital reserve requirements set by central banks, meaning they have to hold a lot of non-earning capital.
Plus branches, legacy IT systems.
Exactly. Massive operational costs. Stablecoin issuers, for the most part, sidestep a lot of that. They're leaner, tech-first operations, so they can capture that yield from the reserves much more efficiently.
So it's partly technological efficiency, but also regulatory arbitrage, exploiting the gaps in the current rules.
That's certainly a big part of the story, especially historically. The rules are catching up, but for a long time, they've operated in this gray area. And that efficiency, combined with the current high interest rates, is why you see these eye-popping profit numbers.
Speaking of profits, let's break down the income streams. Because the interest on reserves is the big one now, but it's not the only way they make money, is it? The sources mentioned three main ways.
That's right. The reserve interest is definitely number one, especially lately.
Yeah, interest income on reserves. You mentioned it's turbocharged by the Fed raising rates. T-bills just pay out more now. And the numbers are wild. Tether reported, what was it, over $4 billion in profit in 2023.
That was the reported figure, yes. Primarily from managing their reserves. It's an incredible number.
Incredible because it actually beat the net income of some pretty well-established traditional U.S. banks. That really highlights the efficiency difference we were just talking about.
It does. But it also highlights a vulnerability, doesn't it?
How so?
Well, that profitability is super sensitive to interest rates. If the Fed starts cutting rates significantly, that $4 billion profit figure could shrink really fast. It relies heavily on the current macro environment.
Good point. So diversification of income matters. What's the second stream?
Number two is transaction fees and spreads. This is more about the plumbing function.
Okay, how does that work?
They charge fees, usually small ones, when large customers mint new tokens, basically creating them by depositing fiat, or when they redeem tokens, swapping them back for fiat currency.
So for the big players moving money in and out.
Exactly. Think about a big trading firm or a crypto exchange. They might need to mint, say, $500 million worth of USDC to facilitate trading or manage their own liquidity.
Right.
If the issuer, Circle in this case, charges even a tiny fee, like 0.05% or 1%, well, on $500 million, that's instantly $250,000 or $500,000 in revenue.
Wow. Okay.
And remember, trillions of dollars are settling using these stablecoins every year across all the exchanges and DeFi protocols. So even tiny fees on that massive volume add up significantly. It helps cover operational costs, compliance, things like that.
It makes sense. Volume makes up for the small percentage. And the third stream?
Number three is partnerships and integrations. This is more strategic.
Like deals with exchanges.
Exactly. Deals with the big crypto exchanges where stable coins like USDT or USDC are often the main currency used for trading pairs. Deals with DeFi protocols that need stable assets for lending or liquidity pools. And increasingly, partnerships with traditional payment companies. Think Visa, MasterCard, PayPal integrating stablecoin technology into their networks. These deals cement the stablecoin's role as essential infrastructure and often come with revenue sharing or licensing fees.
So you put those three together, huge interest income, high volume transaction fees, and strategic partnership revenue.
And suddenly those multi-billion-dollar valuations make a lot more sense, don't they? It's not just about the profit margins today, although those are impressive. It's about controlling the rails.
Controlling the rails.
Yeah. They handle trillions in settlement volume annually. Think about that. Across countless different blockchains, different countries, they are the pipes through which so much digital value flows.
And they sit right at this interesting intersection, don't they? Fintech innovation, DeFi, global monetary policy. But they're still not quite banks in the eyes of the regulators.
Precisely. That unique position is key to their value. So valuations are driven by profits, sure, but also by their strategic importance, those powerful network effects.
Network effects, meaning the more people and platforms use USDT or USDC, the more useful and therefore more valuable it becomes.
Exactly. It creates a powerful feedback loop. Once a stablecoin becomes the standard on major exchanges or in key DeFi protocols, it's very hard to displace. Everyone builds around it, which reinforces its dominance. Utility breeds more utility, and that stickiness is incredibly valuable.
Which leads us nicely into why they've become so indispensable, not just for traders clicking buttons, but maybe for the wider economy, too.
Absolutely. Their role is foundational now. They deliver speed, efficiency, and global reach that, frankly, the old financial system often struggles with.
Like sending money across borders.
That's a prime example. International wire transfers through banks. Often slow, expensive, lots of intermediaries. You send USDC or USDT across a border. It can arrive in seconds for a tiny fraction of the cost, almost frictionless.
Yeah, anyone who's waited days for a wire transfer and paid $50 for the privilege gets that immediately.
Right. And beyond payments, they're crucial for DeFi. Complex lending, borrowing, derivatives, stablecoins are often the core collateral or settlement asset. They provide the stability needed for those more complex operations.
And for active traders, You call them the lifeblood of liquidity earlier.
They really are. Most major crypto trading isn't Bitcoin versus Euro or Ether versus Yen. It's Bitcoin versus USDT, Ether versus USDC. They are the main trading pairs.
The common denominator.
Exactly. Plus, hedging. If the market gets volatile, traders move into stablecoins to protect capital without having to cash out to fiat entirely, which might trigger taxes or delays. And then there's yield farming, providing liquidity to DeFi pools.
Wow.
Stablecoins are essential there too. They're the stable base currency for the entire digital market.
Okay, so the utility within the crypto world is clear. But you also mentioned real-world adoption, connecting this to global events. Where are we seeing that happen most dramatically?
You really see the power where the traditional system is under stress. Think about emerging markets.
Right, the sources highlighted places like Argentina, Turkey, Nigeria.
Exactly. Countries grappling with severe inflation, sometimes hyperinflation. The local currency, the peso, the lira, the naira, is losing value rapidly. People's savings are evaporating.
So what do?
Increasingly, they're turning to dollar-pegged stablecoins, mostly USDT or USDC, as a way to preserve their wealth. They can hold these digital dollars on their phones outside the unstable local banking system.
So it's not about crypto speculation for them. It's basic financial self-preservation.
Precisely. It's a flight to safety, a way to access the stability of the US dollar when their own currency offers none. It's like a grassroots digital dollarization driven by necessity, not by government policy.
That's a powerful use case. And what about the other side, the traditional finance world, TradFi, adopting this tech?
That's the other big trend, the convergence. It's not just crypto degens using this stuff anymore. Look at Circle and USDC. They've deliberately positioned themselves as the regulated, compliant option, and they've forged deep partnerships. BlackRock managing some of their reserves, integrations with Visa for payments, Coinbase using it for settlements.
So Visa is actually using USDC rails.
They're actively building solutions using USDC for things like cross-border B2B payments and faster corporate payouts. When established giants like Visa start building on these stablecoin rails, you know it's becoming part of the mainstream financial plumbing. The lines are definitely blurring.
Okay, so we have this massive ecosystem. Let's map out the main players. You mentioned Tether and Circle are the giants, but they have different strategies, right?
Very different, yes, despite offering similar products on the surface.
So start with Tether, USDT, the biggest one, around $115 billion market cap now.
Yeah, the undisputed leader by size. Tether's strength has always been its global reach, particularly dominant in Asia and Latin America, often in markets where access to traditional US dollars or banking is more difficult.
And historically, maybe a bit more opaque or risk-tolerant with their reserves compared to Circle.
That's been the perception and at times the reality based on their attestations. They've faced scrutiny over their reserve composition but maintain they are fully backed. They seem to thrive by being ubiquitous and maybe operating closer to the regulatory edge in some jurisdictions.
Okay, then Circle, USDC, their approach.
Completely different positioning. Circle has gone all in on being the regulated, transparent, institutional-grade choice, especially targeting the U.S. and European markets.
Since the BlackRock partnership.
Exactly. Partnering with the world's largest asset manager to handle reserves sends a powerful signal about trust and compliance. Their whole focus is on institutional adoption, integrating with traditional finance, and playing a role in things like asset tokenization, bringing real-world assets onto the blockchain.
And the new kid on the block, relatively speaking, PayPal, PYUSD. What's their angle?
PayPal is the big Web2 player entering the game. Their strategy seems clear. Leverage their massive existing user base, hundreds of millions of people, and integrate PYUSD seamlessly into their existing payment apps.
So make stablecoins easy for regular consumers to use, maybe without even realizing they're using crypto.
Pretty much. It's about bringing stablecoin utility to everyday payments and e-commerce, bridging the gap between the existing internet and the crypto rails. A mainstream integration play.
Interesting. But these are all backed by fiat reserves held off-chain, right?
Yeah.
What about decentralized alternatives? You mentioned MakerDAO's DAI earlier.
Right. DAI is the classic example of a different model. It's not backed by dollars in a bank account, at least not originally.
How does it work then?
It's generated when users lock up other crypto assets, primarily Ether initially, as collateral in smart contracts on the blockchain. It's over-collateralized, meaning you have to lock up more value in collateral than the DAI you borrow against it.
So backed by crypto assets held on-chain. More decentralized, less reliant on banks.
Exactly. That's the core idea. resilience against censorship, or single points of failure, like a bank collapsing. But what's fascinating now is MakerDAO's strategic shift. They call it the real-world asset, or RWA pivot.
Okay, RWA. That sounds jargony. Unpack that for us. What are real-world assets in this context?
Good question. RWAs are basically traditional assets, things like real estate, bonds, loans, or crucially, U.S. Treasury bills that get represented as digital tokens on a blockchain.
So tokenizing traditional assets. Why is MakerDAO doing that with DAI? Isn't the point to be crypto native?
Well, crypto collateral can be extremely volatile, right? Ether's price swings wildly. That creates risk for maintaining DAI's peg. By incorporating RWAs, specifically by holding tokenized U.S. Treasuries as part of DAI's backing.
So they're adding safe, stable, yield-generating traditional assets into the mix.
Precisely. They get two big benefits, much greater stability for the DAI peg, and they get to earn that juicy, safe yield from treasuries, just like Circle and Tether are doing.
So even the big decentralized stablecoin is now tapping into TradFi yield.
Yes. It really shows how powerful that yield incentive is across the entire space. It's blurring the lines significantly between pure DeFi and traditional finance strategies. Everyone wants that stable yield.
That's a really key insight. And we should probably give a quick nod to some smaller players too, right? Like FDUSD, GUSD, USDP. They seem more niche.
Yeah, those tend to be more compliance-focused or tied to specific exchanges or regulatory frameworks. GUSD is Gemini's dollar, USDP is Paxos dollar. FDUSD gained traction partly due to Binance promoting it. It shows there's room for specialized players focusing on specific compliance needs or partnerships.
Okay, so we've mapped the players and the models, but no deep dive is complete without talking risks and criticisms. This isn't all smooth sailing, is it?
Definitely not. Despite the utility and profits, there are significant concerns.
Number one being?
Transparency. It's the ghost that always haunts fiat-backed stablecoins. Are they really fully backed, one-to-one, all the time? Especially Tether has faced years of questions.
And the quarterly attestations they publish aren't enough for critics.
Often not. Critics want more full, real-time, independent audits, not just attestations showing a snapshot in time. They want absolute proof that the billions in reserves are actually there, liquid, and accessible, especially during a crisis or a bank run scenario. That transparency gap is a major hurdle for trust.
And related to that, I suppose, is concentration risk.
Huge risk. Think about it. Tether and Circle together control something like 90%, maybe more, of the entire stablecoin market.
Wow, 90% between two issuers.
Yeah. That's an immense amount of financial power concentrated in just two private companies operating largely outside the traditional banking safety nets like deposit insurance. If either Tether or Circle were to fail, or even just face a serious crisis of confidence,
It could destabilize the entire crypto market.
Absolutely. The ripple effects would be enormous because so much trading and DeFi activity depends on them. It's a systemic risk for the crypto ecosystem.
Which brings us back to that regulatory question. If they're so systemically important, why aren't they regulated like banks, especially someone like Circle who emphasizes compliance? What's the gap they're using?
It really comes down to classification and lobbying, frankly. They argue they aren't taking deposits in the same way a bank does, or that they're technology companies providing a payment tool. They operate in this legal gray area between banking law, money transmission laws, and emerging digital asset regulations.
A very profitable gray area.
Exactly. And that ambiguity is precisely why regulators worldwide are scrambling to create clear rules. They see the systemic importance, they see the shadow banking functions, and they want to bring it under proper oversight.
And we are seeing specific efforts. You mentioned MiCA in Europe.
Right. MiCA, the Markets and Crypto Assets Regulation, is a comprehensive framework rolling out across the EU. It sets clear rules for crypto asset issuers, including stablecoins, covering things like reserve requirements, governance, and consumer protection. It's probably the most advanced framework globally right now.
And in the U.S.
Yeah.
Still being debated.
Still very much in flux. There have been various proposals for a Stablecoin Act. Some proposals would restrict issuance primarily to federally insured banks. Others focus on setting strict standards for reserves and audits, regardless of the issuer type. There's a lot of debate about the right approach, balancing innovation with financial stability.
So regulatory clarity is coming, but the final shape is uncertain. And that uncertainty itself probably influences the market.
Definitely. It affects institutional adoption, investment in the space, and potentially those profit margins we talked about if stricter reserve rules or capital requirements come into play.
And beyond the market risks, there are bigger picture implications too, right?
Yeah.
Geopolitical, monetary policy.
Yes, absolutely. Think about the global use of dollar-pegged stablecoins, especially in those emerging markets we discussed.
The digital dollarization phenomenon.
Right. When citizens in Argentina or Nigeria start using USDT instead of their local currency for savings and transactions, that directly challenges the authority and effectiveness of their own central bank. It erodes their control over the domestic money supply and monetary policy.
So stablecoins become a kind of parallel global monetary system, bypassing traditional controls.
In a way, yes. They operate outside the established SWIFT network for international payments and offer an alternative to local currencies. It's a fundamental challenge to the traditional nation-state control over money that has huge long-term implications.
Okay, understanding those risks and the regulatory push helps frame the future. Where is this all heading? What's the impact on Web3 and the wider economy looking forward?
Well, stablecoins are already deeply embedded. They're the fuel for so much activity.
Like DeFi.
Yeah. DeFi's total value locked, TVL, basically the amount of assets staked in DeFi protocols, is heavily reliant on stablecoin liquidity. NFT markets often use stablecoins for pricing and settlement. DAO treasuries, the funds held by decentralized autonomous organizations, often hold significant stablecoin reserves for operational stability. They're just fundamental.
And the TradFi convergence you mentioned, that's likely to accelerate.
Seems almost certain. The involvement of Visa, PayPal, JP Morgan using similar tech internally. It shows the traditional financial world recognizes the efficiency gains. They're not fighting Web3, they're adopting its best parts. And stablecoins are arguably the most successful and practical application of blockchain tech in finance so far. But looking even further ahead, the really exciting development, the next big narrative shift, is likely around programmable stablecoins.
Programmable stablecoins. Okay, what does that mean? Money that has code attached.
Essentially, yes. Moving beyond just being a stable unit of account or medium of exchange, imagine stablecoins intrinsically linked to smart contracts.
So the money itself could have rules embedded in it.
Exactly. Rules that execute automatically. Think about compliance. A programmable stablecoin could be coded so it can only be sent to pre-approved KYC'd wallets. Or imagine automated tax withholding at the point of transaction. Or instant automated settlement for complex financial contracts based on external data feeds.
Wow. That sounds potentially very powerful, but also maybe a bit dystopian.
It has huge implications for efficiency and transparency, automating things that currently require layers of intermediaries. But yes, also raises questions about control and privacy. It's a major area of development and will likely see it become much more prominent around 2025 and beyond. It moves stablecoins from just being better payment rails to being truly programmable money.
A fascinating glimpse into the future. Okay, let's bring this all together. For you listening who stuck with us through this deep dive, we want to boil it down to a few key takeaways based on everything we've discussed. What's takeaway number one?
I'd say watch stablecoin supply growth as a metric.
Okay, why is that important?
Because the total market cap of stablecoins is often seen as dry powder for the crypto market. When you see that supply expanding rapidly, billions flowing into stablecoins, it often means new capital is entering the ecosystem, potentially waiting to be deployed into more volatile assets like Bitcoin or Ether. It can be a leading indicator for market sentiment and potential rallies.
Got it. So rising stablecoin supply can signal incoming liquidity. What's takeaway number two?
Number two relates directly to their business model. Monitor global interest rates.
Because their profits depend on it.
Heavily. As we discussed, a huge chunk of revenue for issuers like Tether and Circle comes from the yield on their treasury reserves. If central banks, particularly the Fed, start cutting interest rates significantly, those yields will fall and stablecoin company profits will likely shrink. That could impact their valuation, their spending, and just the general buzz around them.
Right. So their fate is tied to macroeconomics.
Yeah.
And a final takeaway, maybe for someone thinking about investment angles.
Third takeaway, consider indirect exposure. Since the big stablecoin issuers themselves are mostly private companies or operate in complex regulatory environments, directly investing in them is hard for most people.
So how do you get exposure?
Look at the ecosystem around them. Think about the platforms that benefit from stablecoin growth. Major crypto exchanges where stablecoins dominate trading volume, leading DeFi protocols that rely on stablecoin liquidity, even companies involved in asset tokenization or RWA platforms, as stablecoins are often the settlement layer there. Look at the picks and shovels supporting the stablecoin gold rush.
Follow the infrastructure, follow the flow. Makes sense.
That's where you often find the related investment opportunities.
Excellent. Well, that brings us to the end of this deep dive. We've really peeled back the layers on how these stablecoin giants work, essentially acting as incredibly efficient asset managers, riding the wave of interest rates, and becoming the essential liquidity engine for the global crypto economy.
We touched on the huge utility, especially in places failed by traditional finance, the massive profits, but also the very real risks around transparency, concentration, and the looming regulatory changes.
But as always, we want to leave you with a final thought, something to chew on. It loops back to that core challenge they pose.
Right. So here it is. If these stablecoin issuers are making billions, literally billions, by earning interest on assets that ultimately belong to their users, and if they're processing trillions in global payments and settlements, but without the full regulatory oversight and costs of being a traditional bank, are they just the next evolution of banking? Are they becoming the new global banks? Or are they something fundamentally different, something that needs a completely new kind of regulatory thinking, maybe even a decentralized one?
That is the big question, isn't it? And the answer really could reshape global finance in the coming years. Thank you so much for joining us on the deep dive today. We hope you found this breakdown useful. Maybe you had that aha moment, like realizing the sheer scale of profit from reserve interest. If you did get value from this, the best way to help us keep doing these deep dives is simply to engage. You know the drill, subscribing to the channel, leaving a comment with your thoughts, maybe sharing this with someone else who'd find it interesting. It genuinely helps us out with visibility, lets the algorithms know people are watching, and allows us to keep putting the time into creating this kind of in-depth content for you. We really appreciate you spending your time with us. Thanks again, and we'll catch you on the next deep dive.